Welcome everyone. In this video, I'm going to do a stock analysis for Rivian. However, I want to start with the conclusion before I go into the details. So the conclusion is that I see upside for the next year, particularly within the software and services segment. And to be even more specific, I believe that the joint venture with Volkswagen is bringing a significant upside in terms of revenue, but even more importantly, in terms of margins, because that revenue carries a very decent, juicy 30% gross margin. That said, the automotive segment, it's still not profitable, and until we have the Rivian R2 in the first half of next year, I really don't see things improving aside from some cost reductions in the current models, the R1. So overall, I believe that price action will be quite important, particularly maybe early summer this year. And I think that's going to be an inflection point in either direction. So the market can irrationally sell off. And if that happens, I believe that's going to fuel the downward trend. In any case, let's start now with the thesis, with the details, and I'm going to start with a quick review of Q4 earnings. So the biggest milestone that the company achieved in the past quarter was the first ever profitable quarter from a gross margin perspective. So we had 170 million in gross profits. 110 million of this amount was from the automotive segment, and 60 million came from the software and services segment. So that's about 35%. And I was quite surprised, to be honest, about the 110 million from the automotive segment, because traditionally that was a money burning segment. And if you look at the third point, you can see why. So in Q4, they generated 260 million in automotive regulatory credit sales. To give you an idea of what's that, if you don't know what it is, essentially Rivian, they produce EVs, that's great for the environment. And you have other manufacturers in the US that don't produce as many EVs as they should. And of course, these other companies, they have to purchase these regulatory credits to comply with, with the current regulation. So that's relatively easy money for the company, for Tesla as well. We will see that in a moment to see how much Tesla has been making. I anticipate you that it's 2.4 or 2.2 billion in 2024. And what's interesting about this revenue is that it's high margin, because the company has to sell credits. That's it. Is it a 100% margin? Probably. So that's why, the automotive segment reported that 110 million, gross profit in that Q4. As I said before, the software and services segment is very interesting because it has high margins. Yeah, 28% in Q4 2024. As you're about to see in the video, management is guiding 1 billion in this segment, for next year. So that billion carries a 30% margin. So just in 2025, we're talking about 300 million in gross profits from the software segment alone, which is not bad. Great. So moving on, very quick overview on the one of the points in the income statement, which is the gross profits. I mean, when you look at this, and you don't know what's going on, you have no clue on the story, on the narrative behind the company, and you look at this, you can be, let's say, you can be quite incentivized to just buy just on the 170 million in gross profits, because it's the first ever quarter that the company is profitable. That said, if we go into the details, the reason why is due to it's a combination due to the joint venture and also due to those regulatory credits. So we can see here a breakdown of gross profits for the entire year, not just Q4. So this is for the entire 2024. And you can see the breakdown between automotive and software. So the automotive segment burned 1.2 billion, whereas software and services, they yielded about 7 billion. 7 million. And it's okay. It's good. That's the gross profit, by the way. It's not the revenue. And as I said before, the expectations for 2025 is for the revenue of the software and services segment to be 1 billion. So that's essentially double that we have seen this year, which is really good because if you look at the trajectory between 23 and 24, it's not a double. It's either 20% or 30% more. So software and services, I believe this segment is going to be important this year before that R2 model is released, is launched next year. If you look at this is also the reason I love this, because sometimes I screen stocks based on this specific pattern where the company is, it has negative operating cash flow since it was launched in the IPO, and now suddenly it has positive operating cash flow. And the reason why this is the case is because of a change in unearned revenue. And you can see this chart, this is the change, is 1.6 billion. So essentially the company has made 1.6 billion, they hold that amount in the balance sheet, but they haven't recognized it as revenue because there are certain terms in that joint venture that I'm about to tell you where they cannot recognize that revenue, this cash as revenue, until certain milestones have been met. And finally, also something that helped cash flows in the past quarter was the inventory write-off, which you can see, if you do a write-off in inventories, usually it's bad from a net loss perspective, but that's a non-cash expense. So this helps, to see that spike in operating cash flows. So now I just want to go into some of the details between the software and services segment. As I said, the joint venture is pretty much the most important part in this segment. As you may know, Rivian and Volkswagen, they formed a joint venture. I think it was by the end of last year, mid of Q4 last year. And the idea is to create the next generation of software and ECUs, the electronic control units, where Volkswagen plans to deploy them into their fleet. And they plan to do that by 2027. And one of the things that's quite interesting about the joint venture is, how much are we talking about on the deal? So the group, Volkswagen Group, is planning to invest up to 5.8 billion in the joint venture by 2027. So far, they have invested 1 billion in the form of convertible notes. So that's already checked. Then we have 1.3 billion after the joint venture was closed. And that comes as, 50% stake in so Volkswagen has a 50% stake in the joint venture, as well as some IP, intellectual property licenses. So the remaining 3.5, naturally that's going to be, deployed in the form of equity or convertible notes based on milestones. So this is important. In the headlines, you can see the 5.8. It's like, wow, but it's not exactly 5.8 yet. It's about 2.3. So something to take into account. That was the main headline. You see that's like, wow, 5.8? Not yet. Great. So we have that deal. I think I had some, this is an important excerpt from the earnings call where management says that 2 billion of this deal, they plan to realize it as revenue over the next 4 years. So, it's great. As you can see in this chart, you can see the spike in cash, but that amount of cash is going to be realized very slowly over the next years. In fact, they expect, based on those milestones, they expect to realize most of that amount, later on, so close to the end of that 4-year period. So it's back-end weighted. Great. Now moving on to other, businesses or sub-segments within this software and services segment. We have remarketing, like any other manufacturer. The company it's offering customers to trade in their current vehicles and to sell used Rivian vehicles directly to those customers on their website. They do vehicle repair and maintenance, nothing new on that. They do charging. This is quite interesting. So the Rivian Adventure Network, I have a chart here. So this is the network that the company has. As you know, they are compatible with the Tesla superchargers, which are the green dots on the chart. Now the network, it's not there yet. I mean, yes, they have about 660 charging points. I think there was an article here exactly. So they have about 666 chargers by the end of Q4. But if we look at their plans back in 2021, they said they would implement 3,500 chargers by the end of 23. And, so far we have only 20% done of that milestone. So something to take into account. It's not there yet, and this is as of February 21st, 25. So it's relatively recent data. Great. And I think, the last one, again, this is quite typical from car manufacturers, software subscriptions, like Connect Plus. And, I think they also offer Amazon Alexa as a package. Great. Now, as I said before, we have an outlook for the software and services segment of about 1 billion for 2025 at a gross margin of approximately 30%. So that's really good. We're talking about 300 million in gross profits. And as you're about to see in the guidance, the company expects to achieve a modest gross profit for the full year 2025. So finally, we will be able to see gross profits positive. Of course, it's not operating profit. Of course, it's not net profit. And of course, it's not free cash flow, positive free cash flow. But it's still better than the losses that we have seen over the past years. Great. Now moving on to the next topic, and this is quite important, is because part of that guidance assumes that the company is going to generate another 300 million in regulatory credits. Sorry, when I say another 300 million, I mean 2024 they generated 260 million, and in 2025 they expect 300 million. And well, this is embedded, in the outlook, in the guidance. And considering what's going on now with the new administration, I will be honest, I'm a bit skeptical on whether these regulatory credits are going to still be available this year. I believe once the tariffs, are implemented and everything is more certain on this side, I believe Trump is going to come back at the green credits and the regulatory credits, and I think he's going to remove them. And of course, this will impact Tesla. In fact, I have here a chart where you can see how much Tesla has made every year only from regulatory credits. And that's a significant amount, like 2.7 billion. And is that 100% margin? It's like, I'm selling you credits, which is, I'm selling you air pretty much. So it will be a big impact. And as I said, Rivian projects 300 million in these credits for 2025. So it can be a hit to gross profits because these, as I said, they have high margins, these regulatory credits. Another headwind, and this is another big one, is the 7,500 green tax credit. There is already 2 bills, introduced in the Senate, and one of them is in regards to killing this incentive, which is significant. And then there is another one to impose 1,000 on EV purchases, which, fair enough. If you like them, you should be able to pay more. I don't know. I don't know how this is going to help the transition from ICEs to EVs, but well, I'm not going to judge. And then we have another. This one is quite big. Yeah, so tariffs. is the hottest topic right now. And many people were quite negative by, yeah, tariffs are going to depress the company, and the CEO already expressed his discontent with this tariff on car and parts imported into the US. So of course that uncertainty is gone. Since last Wednesday, we already know that we're going to have these credits. And in the 10K, I wanted to highlight that the company has actually expressed one of the risks related to their supply chain. And they said that they have a global nature, the global nature of the supply chain, and they have risks related by these tariffs. In other words, I believe the company has tier 2 and tier 3 suppliers based outside of the US, and importing parts from there is going to be expensive, 25% to be precise. And even though the tariffs on components is not going to be made effective on April 2nd, the deadline is up until May 2nd. I think it's May 2nd, yeah. So, yeah, something to take into account, because according to the administration, these tariffs will be permanent. So I don't think they're going to be used as, a negotiation factor for the administration to win deals with other countries. This is a really interesting chart where you can see Rivian when it comes to, again, let's leave aside the parts topic. If we focus at the actual assembly, Rivian assembles 100% of their EVs in the States, which is amazing because they're not going to be subject to that 25% tax. It's only the parts, the components, or some of those components that are going to be subject. So Rivian is one of the players that seems to emerge, as a winner from these tariffs, as well as Lucid and Isuzu and Tesla, of course. So yeah, something to consider. And this is the outlook. So management already said that they considered, different headwinds, and all that is already, uncertainties, as they said. All those uncertainties are already baked into this guidance. So the guidance, fortunately, they didn't provide revenues, which, I wanted to see revenues. They didn't. So we have only vehicles delivered, we have EBITDA, and we have CapEx. If we look at what the deliveries figures were for the past years, you can see that there was a relative stagnation between 23 and 24. You have barely more deliveries between these 3 years. And what I find a bit depressing, more or less, is the fact that the upper level of this guidance is only 51,000 vehicles this year. So essentially, we're not going to see an increase in deliveries this year either. So that's about 3 years where deliveries are going to be flat. Not particularly attractive from the automotive segment, but as I said, my case is more focused towards the services and the software segment, which is, higher margin, not higher revenue. When it comes to EBITDA as well, you can see they project a loss, of course, not a surprise. So midpoint is 1.8. The street is expecting an EBITDA, adjusted EBITDA loss of negative 1.87. So slightly closer to that upper range that the company mentioned. When it comes to revenue, the street is expecting a 15.3% increase in revenue in 2025. And as I said before, I was not really happy with the 6.7% in 24 because it's flat pretty much. And this value, it's not particularly attractive because, you want to see growth like the one that they're projecting in 2027, 60% year over year. These are the figures that investors want to see, to justify the valuation ratios. If we look, as I said, at revenue, so the trend is not really, that attractive. It was from 22 to 23, but not from 23 to 24. Let's look at the chart. So a very quick view. If you zoom out, things are very bad, really bad. But if you zoom in a little bit, since April 2023, so that's 2 years ago, the share price has stabilized, around the low tens, which is good because I'm going to do something controversial among value investors. I'm sorry if I do this, but I like to draw lines on a chart. So this seems to be an interesting pattern. And if we do the same with the lower lows, you can see here a triangle. Yeah. And if I was to project this a little bit into the future, please bear with me. I swear to God that I do more than just technical analysis. But my point with this is that this triangle is converging this summer. So usually when these patterns are resolved, the move is usually quite violent and it determines the move for the next, I would say, year. So in this case, we have 2 years, but I wouldn't say 2 years into the future, maybe a year into the future. So I will be direct. If I see the share price breaking this downward, I will be very hesitant to go long on the company, because usually these patterns, they do tend to fuel the sentiment, and if the sentiment is bad, that's going to continue. That's what I'm saying. That's my opinion. Even though the company looks attractive, if this pattern is broken downward, that's not good. That said, if the pattern is, if this upper line is broken, and you have the price speeding up, then that could be an interesting entry point. And that's the reason why right now I really don't know what the market is going to do. There is a lot of uncertainty around tariffs. If the broader market sells off, Rivian could sell off as well on no news or no announcements related to the company. So I think it's quite risky to own at least to go long on the stock before the summer. Speaking of valuation, really quickly, we have EV to sales. Of course, we cannot look at price to earnings, because earnings are negative. Price to cash flow, no point. So we have EV to sales, trading 12 months, and you can see the company is fairly valued. It's the EV to sales ratio, it's trading pretty much at the median of the past 2 years. So I would say the company is fairly valued in this regard. That's why I don't say it's not overvalued. I think it's fine from a valuation perspective. In fact, if we compare Rivian with some of its competitors like Lucid, which I believe is a direct competitor, even though they don't do SUVs and pickup trucks, I still see them as quite early stage. So I wouldn't say that Tesla is a direct competitor, even though they also make EVs. So forward EV to sales is just 2, whereas for Lucid you're paying 4.6. The ratio is 4.6, and for Tesla is 7.1. So on this ratio, Rivian looks quite attractive, and if we look at price to sales, it's the same. Rivian looks more undervalued than its competitors. And what I find even more interesting is that despite being undervalued compared to Lucid, the gross profit margin is quite better than Lucid's. So Lucid is negative 114%, and Rivian's was negative 24.1%. So something to consider, because the company, it's not hyped as other EV manufacturers, probably you know about this one or some others are. So something to take into account. These are my points. I think I will conclude the video here. To wrap up, I believe this summer is going to be important because the triangle is converging. And I do believe that there is a higher chance for the share price to break out of this pattern upwards. And if that's the case, then I will consider myself buying shares in the company. As always, this is not a recommendation for you to do the same. This is not financial advice. I'm not an advisor. I'm no one, pretty much. This is just my opinion on the stock. So thank you very much one more time for watching the video, and I hope to see you in the next one.